Hi everyone, welcome to our webinar today. We're going to get started here in just a couple of minutes, so stay tuned. Hi everyone, thank you so much for joining. We're going to give all the attendees just another couple of minutes to dial in, and then we'll get started. All right, everyone, thank you so much for joining our webinar today. We're going to be focused on incorporating ESG into investment strategies. There's a chat function over in the bottom corner should you guys have any questions throughout the webinar or dialing in or any issues with the viewing. So to start us off, my name is Michelle Winters. I'm VP of Solutions here at GOBI. And just another couple housekeeping items. Our session today will run about 40 minutes in length, and we've left time at the end of the presentation for questions. Again, please feel free to use that chat feature to also submit any questions during the webinar, and we'll try to get to as many of them as we can at the end. The session will also be recorded and sent to all participants. So during the webinar today, we'll be discussing the what, when, how in regards to adopting and incorporating ESG practices and what that can mean for investment strategies. We're going to help you navigate some of these waters, what some of the investors might be looking for, what questions they're asking, and what other communication mechanisms might be out there, including GRESB as a specific framework and potentially launching off point. So before we begin, I'd like to go ahead and introduce some of our speakers that we have with us today. Sean Daly is our VP and Head of ESG here at GOBI. Kylie Ford is an ESG consultant at GOBI with in-house experience on GRESB, TCFD, SASB, and pretty much every framework under the sun. We're also very fortunate to have with us in-house GOBI HQ, Dan Winters, our Head of Americas at GRESB. He'll be presenting on what he's seeing and how GRESB plays a part in it. And then, of course, from across the pond and true expert for all your questions, we have Roxana Isaiu, Director of ESG and Real Estate at GRESB. So, with that being said, Sean and Kylie are going to start us off from the GOBI side and what they're seeing from our clients, frameworks to consider, etc. So with that, Sean, I know you and I have talked quite a bit recently on the uptick that we're seeing in investors, so why don't you kick us off with some trends?
Sure thing. Thanks, Michelle, and it is my pleasure to be speaking to all of you today. We want to do a little bit of table setting here and just kind of start off with why ESG. And a couple things we want to talk through real quick, kind of the drivers behind the participation. So, first and foremost, responding to existing investor requests for increased disclosure. So, kind of with ESG comes transparency, kind of data-driven approaches towards tracking and kind of taking a thoughtful approach towards governance and social policies, all kind of tying that together to be able to kind of be more fleet of foot to respond to disclosure needs and requests from investors, and also kind of any kind of public scrutiny as well. By taking the time to kind of go through and thoughtfully plan out some of these programs, you're setting yourself up for success to then move into the next one to attract new investors. So ESG policy and transparency is kind of associated, and the associated things with that are signals of a well-run organization that uses resources efficiently, that takes a proactive approach to risk management, and kind of values good corporate citizenship. So these are all three things that are driving, kind of investors need to know about and are interested in kind of understanding your policies on. It leads to improved company performance and NOI. So there was a State Street Advisors study that was conducted in 2016, and in talking to a wide variety of institutional investors, venture capital, et cetera, about 2/3 of the respondents identified having strong ESG policies as a key driver behind performance. So putting these programs in place, has a direct impact and translates directly to kind of the overall performance and return on net operating income. Identifying and mitigating ESG risks. So the transparency, excuse me, the risks such as like climate risk, taking that into consideration. Some of the labor practices, operational programs, things of that nature that are associated with ESG, having plans and thoughtful approaches that manages kind of volatility and reduces overall risks. And then finally, staying ahead of industry trends. Through benchmarking, the partnerships, and kind of the community that's sprung up around ESG, really kind of sets everyone up to be kind of trend setters as opposed to being kind of slow adopters and being forced to play catch up. So the community that's popped up around ESG and the investor partners, the third parties support like Gobi, working together to kind of set up set those trends, are really kind of ensuring that there's better success for those that are early adopters. With that, we will transition to Kylie, who's going to talk us through how to engage with ESG.
Yeah, thanks, Sean, and thank you for setting that stage for why we have people coming to us or trying to engage with ESG for the first time. A lot of times, if you're trying to stay ahead of industry trends, if you're responding to requests for increased ESG engagement, you might not really understand what that path is. It can seem confusing and overwhelming. Do I begin LEED certifying every single building I own, or am I trying to benchmark against others? So really, it's more simple than that, and there's a lot of synergy between a lot of the different mechanisms you can use. So one of the main paths you can do is what we like to think of as elevating your ESG metrics, basically using disclosure frameworks such as GRESB, SASB integrating that into 10K reporting, UNPRI, CDP if you're looking into carbon accounting, that kind of stuff. And there's a ton of synergy between these disclosure frameworks. So for instance, if you go through a GRESB disclosure, then you're already 90% to finishing up what you need for SASB, because they use, similar metrics. It's looking at your environmental performance and how you're best engaging with that on a company level with your governance and your social policies as well too. There's also a lot of industry trends towards this elevating metrics. There's an increased focus on carbon footprinting, specifically if you're looking into CDP reporting or something of that nature. And then TCFD is becoming more and more widespread as people are creating climate action plans and looking into those risks. And then in addition to elevating metrics, there's how you're communicating about your ESG. Part of GRESB means looking at how you're communicating inherently, so there's certainly overlap between this as well, what you're showcasing on your company website. But then there's also published company ESG reports and a lot of frameworks for how that might be structured too, such as with GRI. So one of the things when companies come to us and are first looking to engage with these disclosure mechanisms that we get is, well, what do investors actually see? There's a lot of concern that there might be information just freely available. That's really not how this works. With GRESB in particular, which is a large focus for this disclosure, members are able to review public disclosure data, but that a public disclosure score is only given in the case of REITs. So that means that it's what's already out there, and it's basically a measurement of how well you're communicating. Otherwise, you can investors will see a benchmarking report, but they will not see the underlying asset data that goes into it. So you can be secure in knowing that your performance is able to be leveraged, and it's, you know, an optional performance right now in GRESB as well too. But your own data is very much secure with these disclosure frameworks. And then the great thing is the work that we do with a lot of clients that we see on our end is we see how there's sort of this iterative process to engagement with ESG. If you're going to go through GRESB, just picking on that as our favorite example for the first time, the first thing you're going to see once you get your score back is, okay, here's our areas for improvement. How can we do better on GRESB next time? But that almost inherently leads you down a path of thinking more strategically about what disclosure mechanisms you're utilizing, what ESG projects you're doing. Maybe you want to pursue more certifications, so you're going to look into Energy Star and BREEAM and LEED certifications for your buildings, or Fitwell, the new building health that is becoming a really huge market right now. Maybe you're also going to be engaging with people you didn't expect to be engaging with on ESG. A big benefit of this is you have to figure out what policies your company has in place. So you're going to be reaching out not only across departments to really talk about how you're engaging in these strategies, but across regions as well. You're going to have individual property managers that are getting involved on this. And then it leads to a long-term strategy because it highlights areas for improvement. If we can think about that sort of important, urgent sorting mechanism that we have, ESG is oftentimes very important with these concerns and these risks, but not necessarily urgent. And what these disclosure mechanisms can do is just really bring to light the things that are going to be facing your company in the long term, but maybe you're not thinking about in the day-to-day. So that's what we're seeing, and we've seen a lot of increased success. And, you know, going through the process once, maybe you want to create a full energy plan for your portfolio, and it's almost limitless what you can do from the company perspective. And the best thing I think that we've seen is when someone within a company sort of becomes their own ESG champion, and that happens a lot. Who's ever been leading these charges? They can get committees behind them. They can get a lot of support from upper management, from the board, whatever they might be looking at. And it's really exciting for us to continue to work with these clients year to year and see how that's improved. So with that, I wanted to kick it over to Dan now to talk about investor perspective.
I really like that comment about the important but not urgent, right? The ESG often lives in that sort of Stephen Covey quadrant, if you will. And, you know, it's hard to get attention. There's a lot of folks internally in organizations that are pushing. And so that's the sort of bottom-up groundswell that happens. Folks on the line may have heard me talk about random acts of sustainability that happen within portfolios. And that's great. When you do the treasure hunt around the organization, when you're doing a GRESB assessment for the first, second, or third time, it's trying to unearth those things and saying, hey, there's some good things happening in this region or with this division, and trying to get those practices to happen more intentionally across firms is really what ESG and benchmarking and improvement is all about. So when I think about this, we're past the dawn of the age of structured non-financial data, right? That was sort of where we were in 2009, 10, 11, 12, the first couple of years of GRESB, and we've put a structure and a framework around this, and that non-financial data goes to inform how the financials came about. Because what do investors care about? They care about risk-adjusted return. So these three questions that are here are the most common questions that we at GRESB receive from the participants globally as to, you know, what's happening with ESG and what do institutional investors, you know, what are they focusing on, what issues matter the most, and those issues are material issues, and then how do the capital markets use ESG data. So we're going to try to unpack that a little bit here, and let's start with the first. What are some objectives, some ESG objectives, of institutional investors? Well, it can boil down to the things that are on the right-hand side. First thing is they want engagement on material ESG issues. And in real estate, because GRESB is a tailored approach on ESG by industry for the real estate industry, the issues that are in GRESB are quite often material. There are some things about policies that will put you down the road to materiality, right? And so there's do you have certain structures internally within your organization that get you to the next materiality bucket? Is is part of it, right? And that leads to governance, risk mitigation strategies, and ultimately what do institutional investors care about are superior risk-adjusted returns. So they've got some primary focuses. They want to invest in best-in-class management teams. They would like to see best practices implemented, and these best practices come globally. And then they also have some secondary concerns, right? They take a long-term view with their investments, right? CalPERS has $360 billion of assets, and they have folks that are just entering the system now as 22-year-olds who are contributing and are going to want to retire 40 years from now. So they have to take a very long-term view of the market. So something else that's been happening out there, I'm confident that the vast majority of people on this call are familiar with the UNPRI. This graphic shows the number of signatories to the UNPRI. So in 2016, there were some thoughtful folks that got together and defined what responsible investment looks like. And over time, that list has grown. And I called attention to 2015 forward, where the slope of that graph starts to really accelerate. So things are happening in the marketplace to bring momentum to ESG. This is one of those actors that are out there. So when folks are saying, where is all this ESG stuff coming from, right? It's a confluence of issues, and UNPRI is one of them. You're going to see some others with some of the slides that are coming up. When you think about the issues that are being called out, right, these are the issues that UNPRI defines. And so on the left-hand side, climate change, that's a loaded word, right? There's causes and there's effects. Real estate is typically in the crosshairs because it's an immovable, long-term duration asset that is subject to issues of climate change, right? There's water access, we've got plastic issues in the waste stream, right? So those are your environmental things. Social, these are big, high-level issues. And then on the governance side, right, that's what the UNPRI is kind of looking at when it comes to ESG issues. Then there's the rating agencies, right? Big part of the capital markets. So what are they looking at? And, I really thought S&P's title here, going beyond the balance sheet, was particularly apt. So when I think about the 12 things shown on their profile factors, and I started drawing some circles around the effects of real estate, it was 100%, right? All of those issues affect real estate firms. So here we are, very big focus in real estate on ESG. So then if you look at the World Economic Forum's risk landscape, and don't necessarily read the words here, right? They're up here, we can read them, but look at the colors, right? In 2007, 8, 9, 10, that was the Great Recession, a lot of blue on the scoreboard. And then in 2011, 12, 13 forward, things changed. The blue starts to go away and there's an awful lot of green. Awful lot of green. So that's happening. Well, let's see how that changed in 19. So in 2019, the green is becoming more and more prominent. The blue is really fading away. These are issues, big picture, that are driving folks to take certain actions. When you think about, and those were, risks in terms of likelihood. So green issues are becoming much more likely. And then in terms of impact, obviously weapons of mass destruction, it's really hard to knock that off the top spot. However, the other things are pretty green, with water crisis also being rather green in its construct. So that's just, some food for thought. All right. So I want to bring Roxana into this conversation because the next other issue that institutional investors care about are regulatory things that are happening. In the United States, we have benchmarking laws that are popping up at the municipality level, at the state level. There's not a lot of federal leadership on these issues. The SEC actually took a step backwards when it came to disclosure laws with a recent ruling. But in the EU, there's a little bit of a different story. So, Roxana, I know there's a little delay with our call. Do you want to give a little color and flavor of what's happening in the EU?
Absolutely. Thank you, Dan. And hello, everyone. So the EU taxonomy is a very exciting new piece and a very exciting initiative because, first of all, it's trying to standardize the concept of sustainability. It's trying to standardize what does sustainable investment mean for any investor out there that wants to allocate capital to something that has a positive effect, or at least not have a negative effect on the society, the environment, or its stakeholders. And so a couple of years ago, the European Commission initiated this and put together a technical expert group with very smart people from all over the world and all industries and all the types of backgrounds. And the purpose of this technical expert group was to define some minimum requirements and some general characteristics of what a sustainable investment means in multiple sectors. This is not real estate specific. This is not infrastructure specific. We have to think of sustainability generally in all possible fields. However, they did start with a few areas and with a few asset classes because they were more tangible and more and easier to work with. And real estate was one of the fields and one of the industries that they looked at. And what's very interesting is that part of this report, what you see here is just the cover page of this big handbook that the technical expert group ended up delivering. It's a very long document. I would never recommend anyone reading it cover to cover, but if you do want to check out the real estate section, please do. And effectively what they say is that, well, there aren't so many instruments in Europe that we can use for comparability. There aren't that many things, and there's not enough data actually to go about to define these common parameters and the common elements of performance for sustainable investments. So we're going to start by looking and working with what we already have and what exists, and to a large extent, those are the EPCs. The EPCs are energy performance certificates that are obtained by commercial real estate assets in most countries in Europe, and they're the closest thing to comparability that currently exists. Now, they're not perfect, they have many flaws, but yet again, there's something to start with. In the first iteration of this report, the group said that what will ultimately define a sustainable real asset is a minimum EPC level, a building with a minimum EPC level of B. Now, you have to think that a B level is actually quite good because the scale typically goes from A to G, A being the best level and G being the worst. There are differences across countries. Some countries use different scale. Germany uses a color scale. Belgium uses 3 systems, a letter, a color, and a number scale. So obviously there are some things to iron out. But in big lines, and I guess one of the conclusions here and what I would like to get at is that this is this initiative and this piece of legislation is one of its kind, but I'm absolutely convinced it will be replicated and it will serve as a starting point for a lot of other pieces to come. And it would also serve as example and as a starting point for a lot of local adaptations, so country-specific adaptations of this piece. And a lot of investors will look at it for guidance and a minimum starting point to evaluate their exposure to transition risks. Because effectively what this is a handbook or a set of guidelines that shows you ultimately how exposed are your assets to transition risks towards an environment where we're working with only sustainable investments, and what qualifies an asset as investable and as appealing to an investor that has a long-term approach and a long-term view. So an update is coming out soon. And we're keeping an eye on it. Our assessment and the data that we collect is in line with what the taxonomy will eventually ask for in terms of transparency and data availability.
Perfect. And so, you know, the whole point of all of this is to give the folks that are on this webinar some appreciation for the issues and the pressures that are on their capital sources. So there's the need to elevate metrics for the EU, for pension plans that are there who are going to start to collect data and report things about the carbon footprint of their properties, or they're looking at you know, their exposure to less energy efficient buildings. And how are they going to get that data? They're going to ask their fund managers for it. And if they're asking for it in Europe, they're going to be asking for it in other places, Asia, North America, etc. So let's move forward. Oop. Uh-oh. I can't move forward.
Well, while you figure that out, I was
okay.
going to
all right. We're going to go. Yeah, go. Okay, go ahead. We figured it out, but go ahead.
One of the main conclusions and one of the highlights of this exercise is the fact that there's now an increasing awareness over the fact that one of the key concerns and key action items here is putting more pressure on getting the data. What this exercise revealed is that there's not enough data available and not enough good data available to serve as basis for this kind of analysis that would actually inform the development of such a framework. So I'm sure this will put a lot more pressure on this whole point of where do we get the data, how do we get good data, and what does that mean for a manager and their engagement with the property managers and the tenants.
Perfect. Okay, so let's shift gears, and this was something, so this MSCI report was published just to kick off the year. I think they published it on January 2nd. And what was interesting is they put the top 10 ESG trends to watch for 2020. It's at the dawn of a new decade, and I think these trends will persist for the decade. What was very interesting to me is in the top 10, the words real estate were actually called out in trend number 3, revaluing real estate, because it's tangible, it's immovable, and it's, you know, has all sorts of exposures to various climate change issues. Okay, so the whole idea of investing in the eye of the hurricane is a metaphor for other possible risks, and you know what's happening with real estate portfolios. Well, managers are starting to look at existential risks that they're exposed to that they hadn't been thinking about before. But if you look at the other 4 that are here, really all of them touch real estate, right? We're looking for companies that are deploying innovative solutions to future-proof their portfolios. The idea of the human capital paradox really affects the supply-demand of real estate, which is the whole underlying construct of the contracts that drive rent and NOI. New terms for capital, right? We've been talking about the green versus brown discount on the asset level for a long time, and so we're starting to see a more granular focus on risk assessment when it comes to underwriting funds and fund managers. And obviously the keeping score on stakeholder capitalism is really loaded words for impact. And we've got some slides on that at the end. I'll also note that at PREA next week, the Pension Real Estate Association is, for their Spring 2020 conference, is having an entire panel section on impact investing. So it's a real hot topic right now. Okay, so let's get back to, you know, what is GRESB, right? For institutional investors, it's a tailored approach to bring ESG issues to light on real estate. It's set up in an ISO 14000 approach, which Plan, Do, Check, Act, and it leads to 7 different tailored aspects that apply to real estate but touch various ESG issues. We have this interactive data platform that allows the LPs on the left-hand side, institutional investors, which could also be shareholders in listed property companies, right, to interact with their fund managers and listed companies on analytics, performance data, and whatnot. So it becomes this two-way street, a language to help folks communicate. What do the LPs care about and how do they use the data? Well, they oftentimes, and where the market has really moved to is the first bullet there, positive screening, right? Best in class. We'd like managers that are performing well because we think that they're going to deliver better risk-adjusted returns. That's the thesis, right? Structured non-financial data becomes an additional measure of performance that can be tracked over time. We're at the early days of that, but it's happening. And carbon footprint reporting is something that the Montreal Pledge signees in 2016 have now committed to doing in 2020. I know that the draft report for CalPERS is in front of their board right now for approval. And when CalPERS joined GRESB in 2016, they put their separate account managers for both real estate and infrastructure on notice. Please participate in GRESB. Please work to elevate data and start to collect it. We don't think it's going to happen overnight. And so they gave them a 3-year time period to do that. And I will tell you that their real estate and infrastructure portfolios are shining very well when it comes to data access as they went through that exercise. Trying to carbon footprint a $360 billion portfolio is not an easy task. And so the real estate group had more data than some of the other groups, and that was outstanding. Roxana, if you want to jump in, I know there's a delay, please. You can, but you don't need to.
Yeah, no, I'm here. I don't have anything.
I'm sorry. So on the other side, right, the participant. Yeah. Okay. Yeah, I figured. Okay, but I got some stuff for you in just a second. All right. So on the participant side, right, participants, when they get these scores, they perform gap analysis. They go through some management introspection. They're working to get answers that are no to yes, because they recognize that the issues brought forward in GRESB are best practices in the industry. You typically have breakouts where peers start to do some of those things, and those results, when they come in September, are really valuable, and they allow companies to sit down and have conversations in conference rooms to say, okay, well, what are we doing on these things? And take stock of where they are today and set plans in motion to be at a different place in 2022, 2023, because you can't just snap your fingers and get sustainable overnight. It's an ongoing process. Here's a couple examples of how some of our leading investor members use data. So APG is one of our founding members back in 2009. Sander Paul, our managing director, was at APG. And how they use our data is they use it during due diligence. They use it for positive screening. They're looking for companies that not only signed the UNPRI, but are also in their real estate portfolio doing GRESB. APG will actually have fund managers sign a side letter. And that side letter says, for the duration of our investment, we want you to participate in GRESB. We would appreciate it if you benchmarked yourself and got better over time. Sometimes they even put a minimum score in there. It's not a difficult score to achieve, but nonetheless, that's how they're using this. And then they use it ongoing over the 10 years, because most funds are 10-year duration with a couple of 1-year extensions associated with them. So they use this annually to ask, well, what did you think of your GRESB results this year? You know, were you surprised by anything? Are there programmatic improvements that you're doing within the portfolio? Because the key question for any LP-GP engagement conversation around ESG is, what are you doing to make this portfolio better? What are you doing to make your firm more competitive and be a strong partner in our investment success? That's really the bottom line of all of this. When you look at Aviva, you know, they use a really interesting word here, that second line of hygiene, right? Hygiene is ticking a box. Did you sign UNPRI? It's like, yeah, well, if you can't even sign that, you know, you're sorry, we're not going to do business with you. Now, you know, is ESG a driver of decisions? Well, you know, it's one of many things that make up a recipe that lead to an appointment. So does it become a tiebreaker? Absolutely. ESG is of interest to a fund manager, but it's really not a main consideration. Yeah, we might have a policy, we might have done GRESB a year or two, right? But what's a reason to appoint here is ESG becomes central to the investment thesis. It becomes some serious talking points within where is this fund going. And I'm continuing to hear the word intentional from fund managers. People have intentional actions that they're taking with their strategies. It doesn't need to be building certifications, but it certainly can be things like putting marginal capital to work during retrofits and a value add strategy, and being able to articulate that to your capital is really a big trend that's happened over the past 18 months, without a doubt. So here's what that looks like in due diligence, right? They'll take a look at GRESB performance. They'll look at a corporate governance track record, right? In private equity, those corporate governance documents are negotiated up front and then they're put into a file drawer, so there's not really a whole ongoing dialogue. Typically, there's investor advisory boards to have a formal dialogue between the fund managers and the LPs, right? So due diligence becomes quite important to try to understand a company's ESG profile and track record. Then it becomes a criteria in contracts. What happens if there's a failure, right? There's some exclusions of both industries and countries that Aviva cares about. So those come into play, but that's their process, right? And they definitely will work with companies that aren't doing well or haven't invested time yet wrapping their brains around ESG to try to help them raise their game, right? That's that fourth, support and engagement. This isn't, gee, you're not so good. It's, gee, how can we help everybody get better? And I really like that as part of the spirit of ESG, in particular in the real estate industry, right? It's sort of a, we're all in this together. All right, so let's kind of wrap up here. How is ESG used? There's 7 common ESG investment strategies. The one that's been in use most, or for the longest period of time, are your negative screenings. And that can be helpful, but it's also at some level given responsible investment a bad name, because exclusionary screenings can go to things like cluster bombs. Those are bad. Child labor, that's bad, okay. But then you get into the whole, fossil fuel de-investment, and that brings up, well, do you want to be a negative exclusionary screener, or do you want to follow strategy number 6, which is active ownership and engagement, having a seat at the table? And that's where the dialogue kind of splits. Some people are working to divest from coal or other fossil fuels. Others want to have a seat at the table to help these companies get better. Whatever your thesis is, right, there's one of them up here for you. Positive screening, number 3, and sustainable themed allocations are really where the market's at nowadays. They've moved from negative screening or norm-based screening, which are sort of, exclusionary things, to more positive focused. If you look at this survey that was done in 2017 at Harvard Business School, and you dig through, it's a nice tight 25-page paper, but the money is in the tables. So go take a look at table 2. That's the screenshot here on the right. How do investors and why do they use this data, right? They use it because it's material to investment performance. A strong majority of folks said that's why they use it. Now, there's client demand. There's, trying to respond to client mandates. That shows up in number 2 and 7. Is it part of an overall strategy? That's increasingly becoming the case. And then there's some reasons why ESG isn't being used, right? So you have both sides of the coin. When it comes to our investor base, the breakdown of those sort of looks like this. Management engagement happens most often in the private equity space because you have long-term commitments to funds and partnerships with managers. So understanding how your manager is doing and getting better over time is a key focus in the private equity side. On the listed side, these groups up here, Calvert and Cohen & Steers, others, are working hard to do full ESG integration with their investment process. And so they'll typically have, 7 to 10 variables that they're looking at with companies for buy, hold, sell decisions. And ESG has worked its way into a seat at the table as to one of those factors, right? So that's the idea behind integration. Northern Trust has a product in the marketplace, and it basically says you are in the investable universe if you're a listed property company that participates in GRESB and scores 2 stars or higher. So last year, there were roughly 160 companies that participated in GRESB and scored 2 stars or higher that are listed, and that makes up the investable universe for this product of Northern Trust. Rather thoughtful. And then the last one I'll bring up is the S&P Dow Jones Index, which took their real estate index that existed in the marketplace, used GRESB data as an overlay, and gave a portfolio tilt. So awards companies that do well on ESG with a little bit more allocation to their shares, and the ones that don't participate in GRESB are still in the index, but they're in the index a little bit less than otherwise because of that trailing score. The last bit of slides here are the investment spectrum, right? The traditional idea was, here's a bucket load of money. We expect that money to come back to us in return of capital. We also would like a return on that capital, right? Deliver us competitive returns. We have no regard for how you do it. We just want 2 bucket loads of money back from the 1 bucket load that we gave you. So now that idea has changed. And we're now focused in this area here, which is responsible, sustainable, and impact. And if we can draw that down just a little bit, because the right-hand side, right, that's where ESG and responsible investment gets really a bad name, which is, hey, we're going to give up something. We're giving up something for society that we some kind of return. And the conversation is all about earning competitive risk-adjusted returns, doing it responsible, doing it in a sustainable way, and tracking non-financial data in a structured fashion to figure out some positive impacts, or as Roxana said, at least some non-negative things that are happening in the portfolio. So Roxana, I know I rolled those slides. Yeah, you've been sitting there thinking about anything that I missed, any other color commentary, because then we're going to go into the Q&A session.
No, I liked your comment about the bad rap that sustainable investments get, and that's probably one of the most frequent questions that we at GRESB get, is has GRESB calculated, or has GRESB done any analysis on the link or the relationship between financial returns and GRESB scores or sustainability returns? And every time we get a question, at least from my perspective, I'm always cautious about explaining that there's no direct causation relationship. One doesn't cause the other. A very good GRESB score does not automatically imply a very good financial performance. And a very good financial performance on a fund does not directly imply a very good GRESB score or a very good environmental impact for that fund. However, if we look at the performance of the very good organizations, we can definitely tell that there is a relationship and a correlation between financial stability and environmental stability, or a sound way of doing business. And that's just because a proper ESG strategy and a good sustainability level of awareness has just become part of a good way of doing business. And if you think of how the industry is going to evolve and how investors are going to look at this going forward, and how stakeholders are going to look at ESG in general looking forward, I don't think there's any way but accept and understand that good ESG strategy doesn't come at the detriment of financial stability and at the detriment of financial performance. You don't have to sacrifice anything in order to have a good ESG strategy. On the contrary, that's just going to supplement and complement a very good financial strategy.
Awesome. I think that's a great summation to move us into the Q&A. So,
yeah.
So the Gobi folks, have people been active, asking some questions in that chat box?
Well, yeah, so I was just going to remind all of the participants that have joined, there's a nice little chat box over to the side. Please go ahead and submit your questions. We are fortunate enough to have Dan and Roxana here on the line to be able to answer them directly. There were a few just kind of blanket questions associated with sharing the State Street Global Advisory Survey that was referenced at the beginning that we'll send, and of course the slides. But while we're waiting for a few other additional questions, I guess to reiterate, yes, we will absolutely share that with everyone following this call. But for me, something that I hear all the time from potential clients is investors are coming to me saying, we need to get our ESG strategy in place. I have no idea where to start. Go. That is very frequent, the start of every single one of my client conversations. I find that there's a little bit of a unique approach with every single client that we work with. I'm obviously a huge proponent of GRESB, and I think of it as an amazing starting place as a framework to kind of begin that journey. But Dan, just from your perspective with GRESB, or just other things that you're hearing across with all these conversations, would love to When you get that question, what is your favorite response?
Yeah, well, I was in New York 2 weeks ago talking to a big private equity firm, and it strikes me that they are doing a lot of really good things, but they just haven't, put a program together. So one of the things I say is let Google be your friend, right? They're like, well, what should we put in our policy? I said, well, I don't know. What's the DNA of your organization? This is really meant to be all about you. So communicate who you are. But at the same time, let Google be your friend and Google ESG, private equity, real estate policy, go and see what elevates. And, I've sent links out to people using that search. It's quite effective. And you'll find things from long-standing participants. One of the things that I've been trying to do in my spare time, and I'm not as far along as I would like to be, but I started to look back at 2015 and 2016 responses to that simple question of ESG policies. Because the joke I often say is, well, those policies that were coming in at the time is, we recycle and we print on both sides. And that's true, right? That's right. But the things have shifted. People have moved, right? So if you look at companies like Lend-Lease and you read their ESG statements and their policies, oh my gosh, they've moved way beyond that. So we're looking to prompt leapfrogging in the industry. So constantly on the lookout for best practices. Yeah, we're recycling on both sides. That's great. Or you know what I mean. Wow. But yeah. But we're doing a lot more. And that's where the industry has moved. So when you're getting started, it looks daunting. Use GRESB as a framework because these are the best practice issues out there. We purposely don't tell the market what to do. We just elevate the issues and let people benchmark themselves against the global industry on the issues, looking for creative breakouts that happen, whether it's from a company in Hong Kong or the Netherlands or Mexico, whatever, right? The market's going to solve these problems if we let it and we shine a beacon on those that are doing great.
Yeah, absolutely. And something I think that GRESB does really well is the continuous improvement into taking in the trends. You also take kind of the feedback that you're getting from the industry and continue to add on different assessments and questions and pieces to the GRESB assessment. What kind of starts you guys down that path? Maybe that's an interesting question on resiliency has obviously been a key focus that has been incorporated into the GRESB assessment. Do you utilize some of these other frameworks? Maybe that's even Roxana question. But
yeah, let's let Roxana come at this, right? It's how new issues sort of elevate, whether it's modules or other things.
Yeah, I'd be curious, Roxana, from your perspective, we're continuing to see trends and the direction that ESG takes. How is GRESB kind of incorporating these changes, and where do you get that feedback from?
Well, first of all, what I would like to say is that we've never attempted to reinvent the wheel. That's never been our purpose, and that's not something we want to do, and that's not our ambition to always come up with new things just for the sake of bringing up new things and creating more work for you guys. On the contrary, we're working hard on consolidating some of the most relevant issues and working them out through with our strategic partners, be that PRI or CDP or Dow Jones or others. So we're talking and we're working together to so that at least we have some common grounds and some alignment on what are the most material issues and what are the issues that will become more and more relevant going forward. And so this works in the same way with the emerging topics. I see GRESB as a mechanism that looks at what the industry leaders are doing by themselves, with or without GRESB, and standardizing what they're doing, putting it into translating those pieces of innovation and those examples of innovation into a format that can be easily adopted and understood and interpreted by real estate organizations at large. So we're looking at the leaders, breaking those pieces of innovation into something that's comparable and digestible and applicable mainstream, and bringing it forward to the rest of the benchmark. And we work a lot with our partners and with participants and with all sorts of groups to make that happen.
So I made this comment earlier about GRESB being tailored approach on ESG by industry, for industry. So that really gets at our governance structure. So we have, an investor advisory board that's made up of 20-something institutional investors that have been around GRESB for a long time, and they're the ones that are elevating, what issues are material to them or what issues are emerging, right? And so we have had issues emerge in the past, whether it's health and well-being or resilience, and those have turned into modules within GRESB where we kind of take the pulse of the industry to see what's happening out there. Modules live for 3 years, and then we'll take maybe a good question of the 10 that were made up a module and then put it in GRESB, while other ideas will get baked into existing questions that are already in there. An emerging issue right now is cybersecurity. That's a thing. That's something that our institutional investors are talking about. And I'll say that if those investors had their way, they'd ask probably 100 questions, not just the 50-odd that are in GRESB right now. So we have to distill their wants and needs with the other side, which are the participants in GRESB. And we have benchmark committees. There's 4 of them globally, and there's one in the EU, North America, Asia Pacific, and Australia. And these are made up of 15 to 20 folks from the participant side, and they're constantly giving us feedback of the questions that are in GRESB, things that are easy that maybe should all of a sudden become prerequisites, and things that are more difficult. So we take all of that feedback. We also hear from the industry associations around the globe that support us, whether it's RealPAC in Canada or NAREIT here in the US, or along with PREA, to give us sort of synthesized feedback from a large group of folks. And we take all that stuff in, and that's how the 2020 assessment comes about and the 2021 assessment. So it's slow evolution, not revolution, right? We have new folks that are coming in to want to get benchmarked and have become curious on ESG. We also have long-standing participants that are scoring in the 70s, 80s, 90s and saying, okay, what's next? I want to do more, right? And that's leading to the emergence of some new cool products in the marketplace. We're seeing some net zero funds starting to want to get off the ground, right? So that gets the question, what does net zero mean? And so you have to benchmark your portfolio, figure out where it is, implement some things on site to implement reduction, right, through operations, potentially implement on-site renewable generation, and then maybe procure the rest of your energy from renewable sources. That's how you get to net zero. It's an interesting idea that people are starting to float as a fund. So, the market's moving fast.
Well, that's actually a perfect segue into, we got a couple of additional questions that were coming in that were asking even more specifically what additional GRESB modules are currently being worked on. They even mentioned besides cybersecurity being considered, or development of biodiversity, nature protection. Again, this is maybe a Roxana question being thrown out specifically, but are there other modules that are kind of in the works that are being part of consideration for the next round?
So we have a bunch of ideas flying around, and we haven't yet made a decision of what's going to be the next topic that we're addressing. But cybersecurity and modern slavery and social equity and corporate governance would be some of the favored topics. Obviously, we're in the last year, the last of the 3 years with the resilience module, and we'll have to evaluate at the end of the 2020 reporting cycle what are the next steps with the resilience module. That's not to say that after 3 years of evaluating resilience with a separate module, we're done with it and there's nothing more to evaluate on a standalone basis. So this is all work in progress, and as Dan was saying, we're bringing this on the agenda with our governance groups, and we're going to use this year to agree on what is the next topic that we're working on and how do we address this in the best way. At the same time, the investor community as well as our participants do want us to focus as much as possible on what defines performance, and performance that comes from the asset level rolled up to portfolio level and so on. There's a lot of work to be done there. There's a lot of analysis and a lot of many new ways in which we can evaluate performance now that participants are going to report at the asset level in 2020. So even if we just look at that component and we take the concept of performance from the asset level, there are many directions that we can go with it, and that in itself can lead to some modules or some supplementary questions.
Fantastic. Yeah, I think that's a lot of, we get those questions frequently on the GOBI side as well in terms of what we're seeing for trends and what's kind of being populated and things beyond GRESB specifically, but in corporate sustainability reporting, et cetera. So I think it's exciting to kind of see where that industry will go next. Being cognizant of everyone's time here, kind of coming close to the end of the hour, maybe I'll just open it up lastly for Dan, do you have any other kind of like parting words or thoughts or statements to summarize or end your overall thoughts towards this investor relations?
Well, there's the groups that have been doing GRESB a long time, and they definitely want to keep up their score, right? I had a conversation with somebody the other day where in 2017 they got a 5-star and they rested on their laurels. And guess what? They got passed by their peer group. Right, and so they spent 2 years and now they're doing more again. And so there's this, what I like to think and hope that we've created here is a competitive race to the top. Mm-hmm. And when organizations get a GRESB score and it's high, it rewards them, or it acknowledges that they have a program, that program has been successful, that they're working it, that they're doing some good things. And hopefully they have good data in their performance, right? But they've got a good framework. There's the others that have been, sort of thinking about it, but are becoming more and more aware, and they're wanting to get started, and that's daunting, right? There's a lot of work to do. You feel like you're behind, you're on your heels, and that's never a good way to win, any competitive sport that we play. So I always encourage those folks. Don't sit on the sidelines. Get in there, benchmark, learn what you don't know. You don't know what you don't know until you do something. And to your opening question, who gets our data right? We have this grace period. Everyone gets to look at a benchmark score or a benchmark report, and it's not the asset level data stuff. It's just how you did compared to peers at a moment in time. What is a drag are companies that score 17 one year, and then the next year they score a 17. And the third year they score a 17, right? You don't really want to be that. So scoring a 17 is not bad. It just gives you some information. If you can turn that 17 into a 34, you've done twice as well the next year. That's amazing, and you are on your way. So I always encourage people, get in there, start working a program, learn what you don't know, understand that this is a thing that's not going away. We're dealing with structured non-financial data. We've been doing it now for 10 years, and there's a lot more to come. So keep pushing. Step forward.
I couldn't agree more, and I think that is actually a fantastic thought kind of as we wrap up this session for today. We greatly appreciate everyone's time, and we'll be forwarding these slides as well as the link to the other survey that was mentioned to all participants. And then you'll, of course, have my information, our GOBI team information. If you want to reach out to us for any more additional specific questions, we're happy to be here to help you start that journey or take you maybe to the next level of that journey. So thank you, everyone, and have a great rest of your afternoon.
Thank you.